So let us. I think we have a couple of things to finish this notes, right? I think we stopped it somewhere in the delivery channel. We went through QR code, right? We finished the QR code, and we're supposed to make some notes on new delivery channel, new trends in delivery channel. So can you share with me, some of you, what are the new delivery channel that banks are now focusing? What are the new trend? So you all are young people. What are the new trend where the banks are now focusing to leverage? They know that interest incomes are now narrowing down, so they need to focus any other revenue, streams of revenue. So they probably looking into new delivery channel, which is ultimate choice. So they can earn a lot of fee commissions, right? Fees or commission, whatever you name. Uh, so what are the new trends you feel it's important when it comes to
QR codes.
a QR code is something, yes, that is what it is called. Other than that, QR code is something. Uh, there is something called, probably biometric enable ATMs. So you can write something. Probably we will also looking into biometric enable ATM. So under this new delivery channel, you can make some notes and say, you can say exploring, banks are exploring, banks are exploring to use the latest technology. Banks are exploring to use the latest technology. Banks are exploring to use the latest technologies to, to deliver to deliver to deliver efficient services, to deliver efficient services and financial solutions. Efficient services and financial solution. Efficient services and financial solution to their customers. So there are, you probably aware, artificial intelligence are in most of the developed countries. They're using artificial intelligence, robotic and all. You would have seen this as some of the WhatsApp clips and all you share. Robotic is something that most of the uh, developed country using it to cut down the labor cost. Right? So once you spend a lot of money to innovate a robotic uh, device that could cater to all the requirement uh, and seamlessly, the quality is assured because it's pre-programmed efficiencies, right? So like ATM, you have a standard operation. So think of if the innovation is something to artificial intelligence are used in banking. So ultimately, the reduction of labor will be definitely promised. So that is where the banks are now focusing to cut down the cost. Ultimately, remember why bank need to use this new delivery channel, because on the other hand, customers are demanding. Because customer mostly using these devices. So customer wants, they don't want to come to the bank and waste their time. They want the efficient delivery channel. So when the customer demand, now you also see the new trend is customer centric. That means you focus on only the customer. What is customer needs? What is customer is looking for? Then the banks are now adopting a strategy customer centric. Customer is the central person. So he is the main person. You are focusing what is his needs. When his needs is shifting, you immediately cater to his requirement, so that you will always retain the customer. So the focus is to retain the customer. The banks are focusing on more towards the customer centric strategies. So the new trend delivery, you can also say customer centric strategies are used. Customer centric strategies are used by the banks. Customer centric strategies are used by the bank customer-centric strategies are used by the bank. Centric is CENTRIC, centric. Customer-centric strategies are used by the bank. Customer-centric strategies are used by the bank to identify the new needs of the customer, to identify the new needs of the customer, and fulfilling their requirement, So that is other new delivery channel is now banks are focusing on customer centric. That is also other new trend. So when customers are using different devices, they want the efficient services, then the bank strategy also should be focused on customer centric. So not only their business focuses, they are now more focused on the customer. Where is the customer shifting? Accordingly, banks also shifting to ensure ultimately ensure the retention of the customer. So banks are more focusing on customer centric strategies to deliver the customers' different needs in order to retain the customer. Then you would have seen this. I think in Sri Lanka, we are yet to use this blockchain technology. The blockchain technology is something where it's a distributed channel, right? It's a distributed ledger. When a block is added, it's added to everybody. There is no center of any information. But if you look at the bank has a core banking system. That is the base. So everything based on a center point. But when it comes to blockchain, it is a distributed ledger. So whenever a block is added, everybody could see the block is added. So therefore, by using a blockchain technology, that is the way forward. Everybody focusing blockchain technology. Some of the banks, global banks, are using the blockchain technology to trace the outward payments, to trace the payment. So you can say blockchain technology, that is BLOCK, CHAI, blockchain technology. Blockchain technology is being used in certain transactions, such as international payments, wire transfers, and WIR, wire transfers. Wire transfer is bank-to-bank transfer. You call it wire transfer. Then also you can write eKYC, electronically KYC. That is also a new trend. So eKYC, KYC, know your customer. Everybody know. So what is eKYC? eKYC is something that electronically customer data. And I think if you take India, for example, they have introduced a card, I think 12-digit card. Aadhaar card, I think if I'm not mistaken, that is how the name goes as in India, Aadhaar card. That 12-digit card, where if you give the 12-digit card, the entire information of yours is there in the card. So like if you have a NIC, I think Sri Lanka also, they are trying to implement something where in developed countries is a common thing. So if you go to UK, you have a card. That card has every information of you. Simply, if you give the card giving that card connected to anybody, your KYC data is more than enough. So what happens? eKYC is mostly used in developed country. The data is stored in that particular device centrally, and that is uploaded into a card. So when the card details are shared among the banks, they can access to all the information. So that is why you call eKYC, electronical KYC. The data of a customer are electronically exchanged. So that is device is very popular in India. I think they introduced about 5 years ago, little more than that, and that is become very successful because India. Why are we talking India? Because the population. So 1.3 billion population, right? China also same. So China if you really look at it, China, how they track this coronavirus and have a bare minimum deaths and reporting cases because of the technology they use. They trace that. They can track a person with that. With the technology, they can track a person who has come, where is he now currently. Every information can be traceable with the time. So that is how China managed to control the pandemic up to a very lower level. If you look at the population, the world, the highest populated country in the world is China. It's about 1.4 billion people. So they managed to control the uh, pandemic situation because using the latest technology. So that is something you can think of new trends. EKYC, artificial intelligence. Then you can have this. Uh, then also you can, if you want, you can also make a note of on automation. Automation is something that every bank is looking at automation. Automated is the entire process is automated. That means no manual intervention, fully automated. So automated processes also, if you want, you can make a note of it. New delivery channel automation. Automation is something where the entire process is automated through the system. No manual intervention. Everything is automated. So something, if you really look at it, STP, I don't know whether I have shared you this with STP. Anybody can tell me the meaning of what is STP? I will tell you to find the answer easily. It is used in international payment. It is used, this particular STP is used in international remittances. Can anybody tell me what is STP stand for? That is straight through process. Straight through process means when the money coming into the, when the funds are coming into the country, the co-banking system is interfaced with the SWIFT, and when the payments are coming directly to the SWIFT, and that particular co-banking system, since interface with the SWIFT, payment coming from SWIFT is really directly go to the co-banking and identify the customer account, and credit goes to the account. Say if a bank sends a remittances, without bank knowledge, it goes and hit the customer's account. But all these time, how do we process payment? We have to wait for SWIFT messages. Then we'll have to take the SWIFT messages. Based on the SWIFT messages, we have to go and pass the entry, credit the customer's account. That is how we have been doing it. But here, with the STP, straight through processing, there is nobody there. It is system speaking each other. When the payments are coming through through the SWIFT system, it is interfaced with your core banking system. What do you mean by interface? That is connected. These both devices can communicate each other without the manual intervention. But all these time, what we were doing it, whatever SWIFT is a cutoff. SWIFT is a different system. It is not connected to your core banking. So what happened when the SWIFT messages come? You download it. Then you manually process the payment. That is how most of the banks are doing it. Now banks are switching on to STPs. Now gradually bigger banks are switching on to STP, straight through process. What do you mean by straight through process? When the remittance comes, you have to tell the remitter, you have to tell your customer when you are getting inward remittances, you have to only quote your 12-digit valid account number, whatever the account number of that particular local bank said. Some banks might have a 12-digit account number, some banks might have 6-digit, maybe 10-digit, depending on the core banking system they use. So what happened when the payment coming from SWIFT, it is connected to their core banking system. So the payment, if the valid account number is there, it goes and it's the customer account directly. So you can just see, imagine the SWIFT message, the SWIFT system has been interfaced with their core banking system. So how the technology is so developed, where the core banking service provider now trying to give you the facility to connect it to the SWIFT message. So what happened whenever the SWIFT is coming, it goes to a particular customer's direct to his account if the account number is tallied. If the account number doesn't tally, it goes to a queue. It goes to a repair queue. Then you have to manually key in and see whether the account number digit 1, digit 2 are missing. But remember, when you do STP, the danger is, remember, if the account number is correct, the payment is processed. There is no crossing of title and the account number, right? There is no crossing. It won't happen. Say ABC account number is 123. ABC is the name. Account number is 123. So when the payment comes, it goes to 123. Whether account number ABC or DC is not matter. It goes to the 123. So you have to be very careful when the payments are processed, if the valid account number is given, it goes there. There is no checking of title. Sometimes ABC, the message coming with ABC 123 account number. If you really look at it, 123 account number, there is no ABC. Some Almeida, Bertie, Christian, some name, but it comes as ABC. But Almeida, Bertie, Christian is the full name. But it doesn't worry about. It only reads account number 123. It won't check the title. Now, so you have to be remember. So the risk there, if the account number is valid, the payment is processed. That is you call STP. You can say banks are now using straight through processing, STP, automation example, straight through processing, STP, right? So I think that ends our. I think have you all got the notes on this particular subject, banking delivery channel? You got the notes, right? Have you all got the notes?
Sir. Yes, sir.
Right. There are a couple of direct questions. I hope that you can answer those questions, right? There are advantage, disadvantages. Those questions are there. Let me see whether I can. Before we move on to that, compare the traditional banking delivery channel with modern delivery channel with examples. Can you answer that question? Some are direct question you can answer. Compare the traditional banking delivery channel and modern delivery channel with example. So you can see what is traditional banking channel. Traditional banking channel is generally considered as branches is mostly, and if you want, you can partly include the ATM also, because ATM also is joining. So sometimes you can, even if you added traditional banking as ATM, because ATM is so old now, right? So ATM also you can add it. So ATM and branches are the traditional banking delivery. You really look at it, internet banking, mobile banking, or some digital banking, the agent banking, these are the new delivery channels. So you have to compare the traditional banking delivery channel with modern delivery channel with example. So when you compare the traditional banking channel, you can say, you can, if you want the differences compare, you can even write it in paragraph form, or you just write one side traditional delivery channel, other side modern delivery channel. You can say under traditional banking delivery channel, you can say physical presence of customers, physical presence of the customers to the branches stroke ATMs. That is traditional. Customers to come to the ATMs, customers to come to the branches. That is traditional way of doing it. Under modern delivery, you can say it's virtual. Then also you can say delivery. When you look at the traditional delivery channel, they can give a limited operation only. If you have a branches, if you go to particular branches, the branches can cater to whatever that particular branch can give it to you, right? But if you use the modern technology, you do lot of things in through the delivery channel. So the other differences you can say, customer has to personally visit to the respective branch or stroke ATM to enjoy the to enjoy the limited access. So there is a limited access. You can't be every time coming. Your way of coming is you have to physically every time visit. So it's a limited access, right? Limited access. Whereas access to electronic delivery channel, modern delivery channel is unlimited. So you can say access delivery or the services, whatever service that you need to get it limited to that time frame. When they are open only, you can visit. But whereas the delivery channel, modern delivery channel is 24/7, anytime operation, anywhere, right? So you can just based on that you can say the cost is very high, and the other traditional is cost is very high. The cost is very high, and the modern delivery channel very less costs, very less costs. So based on these answers, you can when you say cost mean, you can say maintenance cost of a branch is expensive, but efficient delivery channels are very cost effective, right? Right. Then so in a branch you require more staff required, more human being is more people at work, so more staff required. So here the other one is technologically driven. So this is how you must structure your answers, right? These are basic points I'm just share with you so that you can answer. Compare the traditional. So give some example. ATM and mobile banking is some of the example. You can say you can write. You can you can place your answers by differentiating. One is traditional banking, and mostly when it comes to compare and or differentiate, always put it in a way that the examiner could understand, so that you will get a more marks. If you write in paragraph form, sometimes if you don't have the capability to explain properly, that you might lose the mark. That is what I always say: differentiate or compare. Then always compare by tabulated form. One side traditional, other one is modern delivery channel. So you can easily tell the difference. The scope of work is limited for ATMs and branches. Scope of work is unlimited because you do anything you want to do with that particular through the modern technology. The scope of work, then you can say that time limit to access to service is limited at a branch. There is 24/7 operation. Anytime you can go and operate it through the internet banking, right? And very expensive affairs. Putting up a branch, maintaining cost is very there. The cost is very modern technology are used so that the cost is minimized, right? Elaborate 3 modern delivery channels, provide banking product and services. You know that, right? You can write the modern. I think you can write that answer. Only we touch the difficult question. List out advantage. Yeah, that also you can. Mobile advantage, disadvantage, internet disadvantage, advantage. I have all that is I have given in the handout. You can make all those questions. Try to do that, right? What are the controls banks should put in place to safeguard the bank's customer from the threat identified? That you might have to jot down few points to write that. What are the control banks should put in place to safeguard the bank customer from the threats identified in electronic? What are the threats? You know that hacking is one of the threats. Security is the most concerned threat, right? In latest technology. So what are the banks should do? What are the how the bank could minimize this? I think I in that notes also we are given mitigating factor. So you can, in addition, you can write. You have mitigating factor slide, and also you can say authorization. Then you can answer that number 4 question saying authorization dash, you can say 2-factor or multi-factor authorization. So what do you mean by authorization? When you use the internet banking, you know, when you log in, when you put your whatever the password, you get a dual authorization. That is, one of password is one authorization. You get a SMS alert with a number. So that is called dual authorization. So banks are, when they are giving access to electronic delivery channel to the customers to access to their core banking system, they have to make sure multiple security steps are taken so that unauthorized people cannot access to the core banking system. That is the threat. What happens if the unauthorized person can access to the core banking system? That is the security threat. So mostly when it comes to delivery channel, the security threat is the most common thing you can speak about, right? So how can we mitigate that? The mitigation is only comes with dual authorization or multiple authorization. The authorization is something bank need to make sure the ultimate use only utilizes the services. So authorization. So you can say bank must deploy bank must deploy bank must deploy latest technology. Bank must deploy latest technology to ensure the virtual access the to ensure the virtual access are given virtual access is given with proper authentication with proper authentication with proper authentication with proper authentication. Example, you can say two-factor authentication or multi-factor authentication. Example, two-factor or multi-factor authentication. Then also bank the other point you can write off is uh, the bank must use to protect the system, their core banking system. So you can say secure infrastructure. They have to have a secure infrastructure. They have to secure the infrastructure. Secure infrastructure. And you can say uh, you have to protect your infrastructure, that is your system, right? Secure infrastructure, where you can say the bank has to deploy bank has to deploy bank has to deploy latest technology to protect the customer data to protect the customer data to protect the customer data by deploying by deploying by deploying firewalls. Firewalls is a software they can use it to protect the system by deploying firewalls and encryption. Firewall and encryption. So generally data are encrypted so that ultimately nobody can have a direct access. Encrypted message cannot be read. So encryption and firewalls are a security method that you can use for. Right? These are, and also you can give if you, I don't know whether you look at it, if you really when you go through your internet banking, when you go to your account operation, you have audit trail. So that gives you some alert to you wherever your latest debits are given. So the audit trail also assisting you to check whether these debits are your debits. So you can say audit trail and say audit trail dash, you can say the online banking provides online banking provides the online banking provide the latest transactions latest transaction carried out through the bank account latest transaction carried out through the bank accounts are shown are shown so that so that the customer would access to such details, so that customer or the user, the customer stroke user could access to such details. Access to such details to verify the transaction. To verify the transaction, right? So those are some of the controls in addition to what you written there in the notes. So I have given some banks are using the latest technology, encryption, end-to-end encryption, that also be written. Whatever not there, just jot down it, whatever important thing I'm just sharing with you, right? So look at the last question. Describe the concept of financial technology, fintech. What is fintech? Financial technology, where the company that give the technology, using the technology to make the financial transaction. Say if you say financial technology, means there are companies globally. There are so many companies. Fintech company, if you take globally, can anybody give me the names of global financial fintech companies globally? Use some name. There are so many names. Stripe, STRIP, Stripe is there. Yeah, somebody try to answer. Tell me. Okay, so you can example. Yes.
Swift,
What is that?
SWIFT, Swift.
Swift. SWIFT Swift.
Yeah.
Yeah. So they are also facilitating. Yeah, that is the banks are using the Swift. Swift is one of the fintech company where everybody using, the banks are using their main fintech companies. Swift is also you can important to the bank. There are other companies like if you take Stripe, they give then you have a Chim, Rex, JP Morgan, then you have Digit. These are international popular companies. They give us support to the bank to efficiently deliver the services. They might give automation. They might give different technology-driven automation to make the banking process easier. Now you could see some of the banks in Europe are using everything is technology for total digital. So that manual intervention is very, very rare. So their procedures are very smooth. Even pandemic, most of the bank, even if you take Sri Lanka for that matter, since we have a little bit of payment and all payment method, we have efficient payment method. So the people, while at home, they can do all the transaction because that is thanks to the SWIFT technology central bank use. Because if you have not have the SWIFT system, then it's very difficult to transfer funds to any bank account within Sri Lanka. Since you can do the fund transfer, since you can purchase everything online, so these platforms are very important. So now the people are looking at a different dimension. People are even looking at different dimension. You even need not to go to them. You can buy the service from the latest technology company, because the fintech company, though people say they are threat to the banking, actually it is you can either way argue. You can say you can partnership with those tech company and provide the very efficient service to the customer, because bank only has the customer base, bank only maintaining accounts, the customer base is with the bank. And the accounts are maintained with the bank. This financial company come and giving a service only. So what happens? They can't take the customer's account. No financial company can open a current account, right? So you must understand fintech company operation is they are providing technology that is assisting financial. That's what we call fintech company. They are providing financial technology. So financial technology is where the service is given to the bank in order to efficiently make the delivery by using the latest technology. That is called fintech. So if you take CRIB, CRIB in Sri Lankan context, CRIB is assisting us because CRIB is a company formed by every bank. So they are also now moving into electronic, because the CRIB would have definitely approached as a fintech company. So the CRIB also one of a part of banking sector, right? It's owned by the bank. So the CRIB also using, yes.
Excuse me, sir.
Yeah.
Does the Visa, Master, and Amex also comes under the fintech companies?
The Visa, Mastercard, or yes, indirectly you can also say they are also supporting transaction payment. Yes, Visa, Master also using the latest technology, so that you can add it to the fintech company Visa, Master, Amazon also one of the fintech company. So you can categorize them as fintech company because they use the financial technology, and Visa Master from day one beginning they support the POS machine, the cards, international card. So with their technology only everybody connected. Remember, so eventually you can also categorize them because they are also using the latest technology to cater to the bank's requirements. So the customer is with the bank, but the banking customer, the bank is end of the day, bank want to make sure the customer getting the efficient services. For that, they want to purchase the latest technology. So those technology providers are called fintech. So here the question is, describe the concept of financial technology, highlighting the importance fintech to the banking sector. So what are the things they do to the banking sector, fintech company? uh, they are giving modern IT system. You can say, you can write an answer and say, banks will need to, bank will banks will need to bank will need to reimagine, bank will need to reimagine, reimagine, redesign the traditional banking business, model. Bank will need to, you can say, reimagine, stroke, redesign the traditional banking business model, business model to provide more value added services, to provide more value added services to their customers, either by using fintech, financial technology, either by using the financial technology, or or partnership with fintech companies, partnership with fintech companies. Partnership with fintech companies. Therefore, bank can therefore therefore bank can bank can make use of this bank can make use of this new innovation new innovation bank can make use of this new innovation and technology new innovation and the technology to their product and services, to their product and services. there are areas, there are certain areas, you can say there are certain areas, banks are partnering with fintech companies. There are certain areas banks are partnering with fintech companies. Uh, to provide partnering with fintech company to provide efficient delivery channels, to their customers, such as you can say modern co-banking system. So you can purchase the latest co-banking system. So every co-banking system provider is a fintech company. So if you purchase a co-banking system, every bank has the system, which is provided by the Indian company mostly, and some of the European company. These company who develop these systems are called fintech. So we are purchasing from them. So these are examples, right? So your co-banking system is a classic example of fintech, right? So you purchase the modern co-banking system. Then you can have specialized solution. So if you have, some banks are using a separate package for leasing. Some banks are using separate software for their pawning. So bank, they have credit for some banks are, you don't believe, in Sri Lanka this is happening. Some of the banks use their credit proposal also, credit approval structure, everything automated. It is not manual paper moving here. Remember, inside, if you look at some of the banks in Sri Lanka, some of the bigger banks, not just every bank, some bigger banks, their credit proposals, everything automated. There is no paper. The creation of everything done electronically. It is moving to the committees, members, up to the board level electronically. These are you call full automation. How can you do this without the fintech? You can't think of, because the fintech company can give you a solution to improve your process. You can think of not only delivery channel to the customer, improve the internal bank processes. That is what you call automation. So you can think of and say modern ID, modern co-banking system. Then you can say automation of specialized solution, and you can say you have written specialized solution such as automation, right? Then such as automation. Then also you can think of the speed, the agility, the speed. That is when you are using the delivery channel, you must, when you are using the fintech technology, ultimately the two things. One is efficient delivery, other one is cost. The delivery has to be very low cost. That is what exactly customer likes it. Customer also want to do any transaction at a very lower cost. So you you use the latest technology by make you the efficient delivery at a lower cost. So you can see the speed, the agility, AGILITY, speed and agility, together with cost efficiency, together with cost efficiency, are the important factor by using the latest fintech, by using the latest fintech. Sometimes you don't believe some of the banks have the artificial intelligence, use their artificial intelligence where the customer data has been analyzed. Customer data has been analyzed, and they give the artificial intelligence gives certain decision, right? So some bank use this application, right? Say if you have your particular customer comes into your account, comes and do some transaction. So the pattern of customers' transactions are studied, and that customer data has been analyzed by the system itself, and it gives certain value addition concept. The artificial intelligence identified AI, you call artificial intelligence, identify those data. That is what you could see down the data science become everybody trying to talk about data science. Data science is where you are using the data as a raw material or resources to analyze, and that analytical tool is electronically driven. Artificial intelligence is used to give the important information to the bank to match that particular product to the customer. So unless otherwise you don't now say you have 10 products. If a customer comes and do banking transaction with you, or is the way you operate certain transaction, the customer's database has been analyzed, and the system will give this customer doing this transaction. This customer is making this payment. This customer preference is this. So this is the data has been analyzed by the system itself, not the manual, not by the people. The system identify the way the customer doing transaction, and the system will say these are the product the customer more favorable to the customer. So these informations are electronically done. That is the wonders. So sometimes when you log into some, you can see sometimes when you go and see, I don't know whether you would have seen, when you want to do purchase something online, when you purchase something, a particular product, whenever you go there, that product range are pop up. That is AI, artificial intelligence. They know this particular customer looking for this particular product. Once you select a particular product to buy TV or LED or whatever, they know this guy is looking for electronic item. The system study that. It is not the manual somebody looking at. No, it is the system driven. Then they know what you are looking for. So whenever you want to buy something, that will pop up to remind you we are there. This is the item you are looking for. So that even internet that is using, they are using this artificial intelligence. I think Google using that a very maximum level. So you can see sometimes when you trace a word, next time you need not worry about that word is popping up, because that picks up the word that you use. What you are using frequently, it picks up, and system will give you first-hand information. This is what you. Those are the things that you should think of, right? I think if you can write those answers using the fintech technology on under these categories, if you write one more to added new thing into that, your answer will be perfectly all right. Okay, shall we move on to the other key area? You can see the screen, right? Can you? Can you see the screen?
Yes, sir.
Okay, you got this handout, right? Commercial banking, banking soundness. This is where now we are going to move on to our last phase of lectures. Maybe not last, there are some more. Almost 60 to 70% lectures are now almost completed. So we have 30 to 40% lectures to be completed, starting with banking soundness. This is one of the key areas. What is banking soundness? What do you mean by banking soundness? Soundness means the central bank or two co-objective, financial system stability. How do you ensure the financial system stability? To make sure the financial banks are sound, and you can't afford to make any vulnerable. If a bank is more vulnerable, if the bank do not have sound financial position, there is some issue. That is what banking soundness. So central bank supervision department is the body looking at this, and every supervision is, when you say bank supervision, it comes, there's a separate department called bank supervision department at central bank. They look at the bank, every bank soundness. Are they sound? So why they are looking at the soundness of the bank? Ultimately, the financial system should only have the sound banking system. Every bank should be sound financially. If you have a bank with a weaker financial position, they could collapse. Then if a one bank failure means entire financial system has a problem. That is why central bank is more keen to ensure all the banks operate in this financial industry are sound. They want to ensure the banks are sound. What do you mean by sound? By what is looking at what what are the things that you look at sound that we are going to look at it by looking at a particular model. So before that, bank performance comply with its own internal. Bank will have their own internal policy based on their board level, but also there are state law regulation. So we studied already. Can you give me some of the example? I purposely I put for you to write that. What are the rules? What are the laws and regulations you should know when you are working into banking sector? What are the law? We studied that. Give me some fundamental law. Any bank should know. These are the acts. These are the laws we should abide by when you are doing banking. What are the basic? You studied, right? Banking Act. Yes. Example, you can say Banking Act, Monetary Law Act, Banking Act, Monetary Law Act, MLA.
Terrorist finance.
What is that?
Terrorist finance.
Yes, that also you can. AMLP, yes. So Banking Act, Monetary Law Act, then Foreign Exchange Act, FTA, Foreign Exchange Act, yes.
Pawning Act, sir.
Yeah, Pawning Act, yeah, all that operation you can say. Foreign Exchange Act, then
Bill of exchange.
Bill of Exchange. So more than that, if you can, in exam point of view, if they are asking, remember the priority should be given when they're talking about the important law banks should know. It's definitely Banking Act and the Monetary Law Act take the first two position. Then you can think of writing Foreign Exchange Act. Then you can think of Inland Revenue Act, because that is the other body. Inland Revenue Act. You have to pay taxes. The bank has to pay taxes. So bank should know what is the Inland Revenue Act. So these are the key: Monetary Law Act, Banking Act, Foreign Exchange Act. Then you can think of Inland Revenue Act. Then Prevention of Money Laundering Act. Yes, PMLA. Prevention of Money Laundering Act. PMLA. Prevention of Money Laundering Act. Then FTRA, Financial Transaction Reporting Act. Financial Transaction Reporting Act, FTRA. Financial Transaction Reporting Act. So likewise, you can think of, right, the financial. There are three laws passed now for the anti-money laundering: PMLA, FTRA. That is combating for terrorist financing act, right? That also you can write off, right? The CSTFA, right? Just check it, CSTFA, combating financial terrorist financing, terrorist financing act. Right? That is also one of the act passed, right? Right. Then these are the act you should know. Okay. What are we talking? I think I take this model. The banking soundness can be easily understood by this particular model. So camels, though we are not using in Sri Lanka, but I took this as a model for you to. If you look at the banking soundness, there are certain factors that is given important. One is capital adequacy. The camel C stands for capital. Other one is asset quality. Other one is management efficiency, earnings, liquidity. So this particular model covers everything. Though we are not practicing, but eventually these are for you to easy to understand. Remember, that's what I took this model, camels. Camel, remember the camels. Camel stand for C. So the capital adequacy is something everybody talking in Sri Lanka. And not only Sri Lanka, every bank globally. What do you mean by capital adequacy? I think I don't know whether I explained in the first class. What is capital adequacy? That means when you are taking public money and when you are giving loan, I told you if the loan become bad, right? can you tell the depositor, sorry, we are unable to pay you because your money has been given in the form of a loan and that particular borrower didn't do better. So therefore, we are unable to pay. Better luck next time. Can the bank tell that to the depositor? Can the bank tell to the depositor?
No, sir.
No, sir.
No way, no way. You can't tell. Then what is the financial system here? If a depositor come and deposit the money, when he wants the money, the bank should, loan can be, that is the bank discretion giving loans. Whatever depositors' money, you do whatever. But remember, if the depositors come and demand the money, you should have liquidity. You should have liquidity. That means you should have money to repay the depositor. So you should have a liquidity. And also remember, if the particular money, what the depositor's money you have given in the form of a loan, that loan become bad, and that is become NPA, non-performing loan, and the particular loan is you are unable to recover single cents, that is total loss. Then you have to bear that loss out of your own capital. That is what you call capital adequacy. So every bank should increase their capital. Why globally everybody telling bank to increase their capital? Because banks are into risky business. Bank take the depositors' money and lending it to different businesses to earn more, right? To earn more. In these risky processes, banks are exposed to more risk because they are giving loans to different industry. Now we are going to learn in this session, in this particular chapter, what are the industry, why the industry become failure, what are the external factors that can be threat. Though the customer, the borrower is very good to repay. And now think of current situation, classic example. Every borrowers are willing to repay the loan, but their business is stuck. So these are external factors. Whatever credit evaluation you do, but ultimately the borrower is unable to pay because of the global pandemic or industry related or geographic related issue, then the borrower is unable to pay. So that doesn't mean the banker can pass that particular loss to the depositors. No way. So bank has to absorb such losses. That is what bank has been asked to increase their capital. That is what you mean capital adequacy. So what is capital adequacy? Bank should possess enough capital in the event of a financial losses incurred due to the loss of a loan, or if the loan become bad, that loss need to be borne by the bank out of their own capital or out of their earnings. So what happens if you look at the banks are earning billions of profit, right? Those billions of profits are not shared among the shareholders. The portion of it shared among as a dividend to the shareholder, balance they are accumulating. That accumulation is called accumulated. They have reserves. So bank is accumulating every year profit, then accumulating. So they have a capital, issued share capital. Other than the capital, they have enough reserves. They have accumulated reserves. Earnings, accumulated earnings. These are carried forward for future expansion of the bank. If the bank looking for upgrading their core banking system, they have to spend 5 billion rupees. So where do they find money? Out of their profits. So they make billions of profit. That billions of profits are not shared because they can't share everything to the shareholder looking up and wait. No, they have to progress. They have a vision mission. They have to travel through that journey. So they need to have money. Whatever the money they earn, they only share a portion of it among them because you have to keep the shareholders happy because you are doing business with their money. When I say business, your capital. But bank is doing business not with the capital. Bank doing business with the depositors' money. Unlike other companies, the difference between bank and the other company, what is the difference? Can anybody tell me? What is the difference between bank and the other company? Financial companies or any companies, you take any businesses and the bank. If you get a question in exam, just tell me, how do you differentiate? The banks are doing business and the other companies are doing business. What is the main difference? Anybody?
Banks do business with the depositors' money.
Bank?
Banks conduct their business with the depositors' money.
The banks are doing business with the depositors' money. Other businesses are doing businesses whose money? Their own money. Their own capital. Yes. That is what they are going for a loan. say if you are doing a business, you do business with your own money. So remember, you do business with your own money. If your business wants some more money, you go for a bank loan. That is what every business does. So that is where all the business, everybody put their own capital and run the businesses. But if you look at the bank, it's a different model, because bank do not use their capital and do the business. Why it cannot be done? Somebody might say, sir, why are you saying, why can't bank capital can be used and do businesses? Can anybody tell me why it is difficult? So difficult, it's not practical to do business with a capital. Why? Can anybody tell me why? One is you don't get more capital. The billions of money you want to lend, so you don't have so much of capital first place. You have a reasonable capital only they can put. They can't put billions of trillions of money. Look at the balance sheet of the bank, it's trillions. The balance sheet of the banks, commercial and HNB, Bank of Ceylon, People banks are in trillions. That means 1,000 billions, the balance sheet. They are growing. They are bigger bank. The asset base is trillion. So you mean to say the entire is no, only very portion, maybe 5% or 8%, maybe 10% is only their capital. Balance 90% are depositors' money. So the bank is lending. The bank business is lending. Therefore, they can't take the capital of the bank shareholders' money and lend. Why? It's very expensive money. Because each time the shareholder expecting a profit of more than 15 to 20% return, he wants it. So how can you give a return of 20% by taking the capital, which they're expecting every day 10 to 15%? That itself capital cost. Each shareholder expecting a dividend of 10%. So if you take the capital and go and give the loan, the capital itself costs you 10%, because the shareholder expecting 10% return every year. So how can you give 10% capital if you are using the capital funds, banks, capital, shareholders' money and do the business? Already the fund is cost you 10%. So you have to look after your administration cost. You have to make a profit. Then you are going to lending at the rate of 15, 70. Is it possible? Can people borrow at that rate? No way. You can't. The capitals are used to as a buffer. That means in the event of something going wrong, you are making millions of profit, fine. But in the event of a loss come because of the bad loan, bank has to absorb out of their capital. That is what the capital adequacy. So remember, unlike other businesses, banks takes the depositors' money and doing businesses. If the depositors' monies are taken, if the depositors' money is given in the form of a loan, if the loan is unable to recover, as a result, there is a loss. That loss cannot be passed on to the depositors. The loss needs to be absorbed by either they would have taken some security to realize the bank don't give loan to everybody without security. So the bank also take precaution. That is the reason. That is the very best reason. It is more difficult when you go to the bank to take a loan. Everybody is saying, I want to go to take a loan, but bank is asking so much of why they asking so much of security. Now you can understand. Now you can link why bank is so stringent when they are giving loans, because they are giving the depositors money. They want to ensure whoever person taking the loan has to repay the loan. If the person doesn't repay, that is, they are going to absorb out of the owner's money, capital. The owner is going to shout at the bank management. The shareholders will shout at the bank manager. What are you doing, man? You are taking our money and you are doing businesses, and the businesses incurring losses. You are taking our money to write off the losses. Why are you doing? They are shouting. The board will shouting at the people, and they will ask them to go out of the company. So the banks must be ensured. No, they can't take their capital to write off the losses. They must ensure whatever the loan they give, ultimately the borrower has to repay the loan back to the bank. That is what bank put more stringent credit proposal. When they're asking, they say you are going for housing loan. Bank is asking, okay, mortgage the house to us. Why are they saying? Because they are taking the depositors' money and giving you the loan. If you are unable to repay the loan, bank should have something to recover the loan. They can't go to the director and say, we had a 10 million loss, can you take your money? No, the shareholders will shout at us. So bank should know, okay, if I am giving a loan, if the borrower doesn't pay, what is my option? I should have something to fall back and recover. That is what they are taking security. So now you know why is more difficult bank to take loan, because banks is giving the deposit money. That is why they are more stringent when you take a loan. Why they are putting all these precautions? Because it is a depositor's money. So you understand now, right? That is all called capital. What is asset quality? Now tell me what is the biggest asset of the bank? Now tell me. Then you know what is asset quality. What is the biggest asset of the bank?
Customers.
What is that? Custom. Now we studied assets and liability, right? Two things we
Yes.
study. Assets are what?
Loans and advances.
Loans and advances. That is the answer. Yes, your assets are loans and advances. Your liabilities are deposits. Your liabilities are deposits. Loans and advances are your asset. Asset quality means you have all the performing loan. That is what asset quality mean. Here, the loan that you are given are good loans. All the borrowers are repaying the loan. That is what you call asset quality. If some bank come and say our asset quality is good, what do you mean by asset quality is good? Their loans are very good. All their borrowers are repaying. You call performing loans. How do you call that? Performing loans. Performing loans and advances. You may call it PLA. Performing loans and advances. PLA. Performing loans and advances. All performing loans are called asset quality. If your asset quality dropping mean what? The bank asset quality is dropping, not good. What do you mean by that? That means you don't have performing loan, you have a non-performing loan. Yes. NPA. What do you mean by NPA? That is what we are going to study today. NPA is non-performing loan. That means your loan, whatever you gave, the borrower is unable to repay the loan. So that is become a non-performing loan or non-performing advances. Or you can say NPL, non-performing loans and advance, NPLA or NP. Some people might say NPL, non-performing loan. Some might say NPA, non-performing advances. Right? So your NPAs, non-performing advances mean your loans are non-performing. That means your asset quality is dropping. So you must understand your asset quality is good mean you have performing loan. What do you mean by performing loan? All the borrowers are repaying the repayment well on time, including the interest. Non-performing mean the person who borrowed the loan is not repaying either interest or including the capital is not repaying. So that is called non-performing. That means your asset quality is dropping. So remember, asset quality means the quality of the loan that you lend to the different borrowers. Right. Management efficiency. How do you manage efficiently? How do you manage your liability and assets? Called management. If your bank is very smart, you can take all the depositors' money and you efficiently you now look at why you are taking all the depositors at a very lower cost. That is the privilege given by central bank to the authorized dealer. As authorized dealer, you can canvas deposit at a very attractive price. 3% you are canvassing savings account, 2.5 only you are paying for savings. Right? FD you are paying for 6%. But look at the loan you are giving at the rate of what 9%, 10%, 11% they are giving loans, right? Current situation is totally different. Now central bank comes and say you can't give loan anything for this person. This is for the pandemic. Last 2 years we have this. But once this pandemic is over, banks will have the normal rate. The rate will be more than 10, 15, 16%, right? So now rates are lower because the deposit rates are also lower and the lending rate also accordingly it is low. But general tendency, bank take the depositors' money at a very cheaper level, cheaper cost, and lending it at a higher cost. That is where they are making profit, right? So the management is that efficiency, right? Earnings, how much the bank earn as a profit, that is also important because when the bank earn profit only, they are in a position to bear the losses. So all their earnings will add to their capital. So if you are doing individual business, when you are having profit, that profit is added to your capital. Say you are doing a business, you do some businesses, you put 5 million rupees and do business. Every year you are making a profit of 1 million. That 1 million goes and added to your capital. Next year your capital is 6 million. Next year you are making another 1.5 million. You are adding to your capital. So you have your capital growing. In any business your capital has to grow. But in banks, bank have their capital, but bank will have the funds, accumulated earnings are there in order to expand the future businesses plus the
bad assets become financial loss, they have to bear that also. That is what remember the NPA, non-performing loans. You can't. No bank can say in the world we don't have NPA. Can any bank say we don't have NPA? What is your answer? Can any bank come and say no? All our loans are performing. We don't have a single NPA. Can any bank tell that? Can they tell or can't they tell? In any economy, can any bank will have all their performing loan? They don't have a single NPA loan. Can they tell like that or can't? What is the answer? Because remember, non-performing loan, no bank in the world can say we don't have NPA. NPA is there. You can't avoid. Remember, you are giving loans to different industry. You can't expect in any country all the industries are doing well every time. No way. It won't happen. It won't happen. There are certain industry doing very well. There are certain industry not doing very well. It could be vice versa over a period of time. Change other way. So doing company may not doing well. Not so doing well company may doing better. Right? This is how the market react. Right? So you should know. Okay, in any given time, if you look at the economy now, currently it's a pandemic situation. You can't take this situation as a normal. This you call new normal. It's a very new normal. This situation is not a normal. It's a very new normal. So this even a new normal situation. Now think of the industry that are doing very well, industry that are not doing very well. Give me example. If you get a question with the current pandemic situation, identify industries that are doing really well. Identify industries that are not doing well. Give me at least each example of one example of each industry doing well, not doing well. Let's see whether you are with the current social responsibility for you to understand this. Give me example. Which industry doing very well now? Which industry not doing very well now?
Tea industry is doing very well.
Which industry?
Tea industry. Tea
industry. Okay, you can say tea industry doing well. Okay. Any other than the tea industry? Certain garment industry doing very well because they have this mask and personal protection equipments. They are making personal protection accessories. So certain garments are doing very well. Certain pharmaceutical companies are having a lot of business. They want these medicines. They are really doing well. So and the online businesses are really they are doing well. Everybody purchasing. If you look at Keels and Cargill, they have a wonder. They have a supermarkets are doing really well because people are confined at home. They are doing everything online order. So those industries are really doing well. But the affected industry is hotel sector, restaurant sector, tourism. Where not a single person coming. The entire industry. That is the reason now that those hotel people are now they voluntarily come and helping government. Okay, we will make this hotel as an intermediary care for COVID. Because you can say most of the hotel premises are given for intermediary care. That means they are intermediary between hospital. Better than the house, but not better than the hospital. They are intermediate. So if a patient positive COVID, he can, if he has some money, he can go to the hotel and take rest there. Because he has been isolated. Then, and also they will be definitely the hotel has to join with the hospital. So hospital will take care of hotel and they also make some businesses making this COVID patient be admitted in the intermediate care and then doing businesses. So this is how the industry structure, right? So you should know at any given point of time, no industry, not a single country have all industries are doing well. No way, it won't happen. So the NPA is something inevitable. It is there in the, you can't avoid the NPA. So NPA at the rate of 4 to 5% are acceptable. 4% of your total loan become NPA. That is normal. That is normal. If your NPAs are matched, anything less than 4, it is superb. If your NPA was 7, 8%, that's not very well. Your NPAs are little high. So your asset quality, remember, your NPAs are increasing, your asset quality drops, remember. Your NPAs are reducing, your asset quality is better. So remember, increasing NPA affecting the asset quality. So the asset quality drops if the NPA increases. If the NPA improves, asset quality increases. So remember the link between NPA and the asset quality, right? Liquidity is, what is liquidity? Liquidity is something that you should have money. If the depositors come and demand the money, you should have money. That is what you call liquidity, cash form. You should have a liquidity. So to repay the depositors, right? Liquidity. Market sensitivity is a market reaction. How the market is reacting. Now see the exchange rate is fluctuating. That is the market sensitive. Fuel prices increased. Gas prices increased. Also market sensitivity. All are external factor. Okay. So that is where we are short of dollar. Now there is a huge demand for dollar because our dollars are dried up. We are not getting dollar. You should know basically what is happening in the country. We don't have foreign reserve. Why we are into this position today? Because our inflows are coming from main sources of tourism, exports, worker remittances. Now all three got affected. Of course, the export proceeds are coming, of course, at a reduced level. Now most of the governments they are switching on to the mask and personal protection accessories, not in the real garments industry, because most of the shops are closed in the developed countries. They don't have much orders. But instead, they are doing these kind of for the interim period. They are doing to these protection, mask protection. I think yesterday news in Sri Lanka, one of the masks is found by some company. It gives 99.9 protection from the coronavirus. So the infection is cut off up to 99.9. So they are putting 3 layers where the virus cannot getting into your system. So that is they are given for the international patent. Once the patent is approved, they might get a better order. So these are where they are focusing, right? So that is where sometimes if you go and give a loan to hotel industry, they might not doing well. So as a result, you have NPA, right? So that is how it's changed sensitivity. So okay, so the year. This is where we are going to look at what is non-performing loan. So you can see the picture I have put. They are into problem. NPA loan mean where borrower is not likely to pay any interest nor repay the principal amount. That is what NPA. Non-performing loan. It is not a good sign. NPA is not good, right? Remember. So it ceases to generate income to the bank in addition to reduce the profit of the bank. Yes, if you have NPA, your profit will be definitely comes down because you don't have interest income. Not only that, the biggest challenge is you might not get your capital. Then what will happen? You have to absorb, you will be incurring a financial losses. If your interest doesn't come, okay, at least you will recover the capital. Sometimes you won't be able to recover the capital. Say, for example, you are given 1 million rupees loan to somebody. That somebody has to pay that 1 million loan, interest 5,000 and 25,000 capital. So he has to pay 25,000 reduction of 1 million loan and interest for that loan is 5,000. So he has to pay 25,000. He is not paying anything. So you don't get your 5,000 interest income. That is okay. Your interest, only your interest income gone. But what happens if you are unable to give the entire 1 million? So you have a 1 million loss. You are going to write off from your profit. So you see NPAs are very dangerous. You are not getting the interest. Sometimes if you don't get the capital, that's the bigger loss. That is what banks are very much focused when they are giving loans. So MPS is something that you need to be focused on, right? This issue likely to get worse due to the overall economic slowdown. That is what really happening to our country now. Economics are very slow down. Lot of global challenges, right? So, but remember, when you are giving a loan, you are getting certain signal from the customer. It won't immediately go as a bad loan. Remember, when you give a loan, you get an indication. That is what you call early warning indicators. What is early warning indicators mean? There are early warning indication you get and you have to react immediately. You can't delay anything, right? That is, I put into the span. If you give a loan, there are time frame. There are 4 type of warning signal can come. One is financial. That is very important warning signal. Financial behavior also based on the financial. The behavior of the customer changes. Geographic is the area where your business is. Industry, the particular industry you are into, whether agriculture, into or hardware or into service sector or whatever industry, or whether you are bakery, pharmaceutical, or whatever industry you are in, right? So let us see financial indicators. Financial indicators are among the most reliable ways to target the asset related issues. So when you are when a loan is given, remember you have been getting certain signal that is called warning signal. This particular borrower has some issue, so you have to be careful. That is what warning signal. So remember, what do you mean by a warning signal? That is what you call red flag. Red flag is alert. There your customer into some difficulties. What are the indicators? You can say I have bullet form given. A late loan payment, a sudden overdraft can be, yeah, all of a sudden you can see your customer is not keeping the money in the account to recover the loan. Then you can't leave it as it is. You have to immediately talk to the customer. That is what some banks, some foreign banks, see, when you take a credit card, if you don't pay your minimum fee on the due date, you get a call from HSBC. Or other banks might call you. They might call you. Even now, every bank follow this. That is the best way to do that. You have to call the customer and trace the customer and say why you are not depositing the minimum deposit and the due date is left. And they send a nice message. If you are deposited, they send the message, your due date is tomorrow, please deposit. Some banks are now sending SMS to the customer. They are giving alert because until he's waiting last day to repay, whether the particular person has any issue. This is where you say a late payment. If a late payment is there, you must act immediately fast. Frequent inquiry about the borrower. So you are getting a call from other banks and other financial institutions about a particular customer, our customer, whether he's okay, whether he has taken any loan. They are asking about the information. Now with the crib and all, these are less. They don't call anybody now because they get a crib report. Now with a crib report, you don't call. But when there are query coming from Inland Revenue, this particular person has to pay taxes, he is not paying taxes, the Inland Revenue notice is coming to you. Then if you have a money, you have to block it. There are query coming about this particular customer. Those are warning signals. If your customer is good, you don't get a query about the customer now. If you are getting a query, you know the customer into some financial difficulties, right? Rise in the number of return checks drawn on the borrower's account. That means whatever account checks that he gives is getting returned. When the check I think we had discussed, right? When a check is returned, it's not a good sign at all. Remember, when a check is returned, that is not good sign at all. That means that is going to reduce your credit score. If you take the developed country, once a check is returned, your credit score will go to bare minimum. That is the worst thing you can do. How can you give a check without funds in the account? That is called your check is returned. Why? You don't have sufficient fund in the account. If the check is returned due to technical, that is no problem. But if your check is returned due to insufficient fund, refer to drawer, it's not a good sign. So you must understand, if a check is returned, it is some customer is into problem. You have to immediately go and meet the customer, right? These are the warning signal, right? Return checks drawn on the client accounts. Return checks drawn on the client's account. So there are two things here. You take the depositors, take the account holder, get the checks and deposits, those are getting returned. His own checks also getting returned. Rise in the number of return checks on the borrower's account. Return checks drawn on the client's account. So client's accounts, his own accounts. So both are getting returned. Now remember, there are two things. Either you, as a customer, you will issue your own checks. That is getting returned. That is very bad. Or sometimes you take the others are giving check to you. When you deposit the check, those checks are getting returned. So it gives a meaning. When your own check getting returned, that you are not provided the funds. When you deposited your customer, the customer's client checks are getting returned. That means our customer dealing with bad customer. So both are not good sign. Customer's own check getting returned, not a good sign. The check deposited by the customer given by others getting returned, also not a good sign. Both check returns are not a good sign. Loan facilities are fully utilized. If he has a limit, he's already fully utilized. He doesn't have any leeway to do new businesses. that is also not a good sign. And you can see extended period and request for extended period. So that means he is fully utilized. His facility is going to expire. He wanted the period to be extended. Then you know he's into some financial difficulty. These are some of the indicators. A sudden unrequested overdraft facility. All of a sudden he comes and say, I want to overdraft facility. Then if a business going as per the plan, you don't come in a sudden. If he's a valid reason, yes, that's fine. But if he's not a valid reason, if he's into problem, you get a request from him. Frequent cash flow requirement. So he comes and say, I don't have my staff. I say a small business where 5 people are working, and those people's salaries are to be paid, but the customer comes for a loan facility because there is no cash flow to pay the salaries. He comes for a loan facility. That is something you have to ask for. Why you are not planned for it? Why you are asking on the last day for overdraft facility? Or you want a cash flow to pay their salary? These are, you can see payroll delay. Salaries payable to staffs have been delayed. If you are working in a bank, your salary is credited on time because you are working for a bank. But if you are working in a company, sometimes your salaries are not credited on the salary date. You are concerned, no? Because you are depending on your salary. Sometimes if you are working in a garment factory, right? If your salaries are not credited, then you are worried. Why my company not paying my salary? Because the garment industry has some financial difficulty because they are taken a loan and they are not repaying the loan, and they can't go to the bank for any loan to pay the salary because their limits are full. So there's some issue with this garment factory. So that is what bank has to find out, right? More necessity, increased litigation against the client. Lot of cases coming, court cases are coming about this particular person because he is into a lot of difficulty. The last important point, more necessity for guaranteed payment to the creditors. That means people who have given credit to this particular customer now asking bank guarantees. All this time they have been given credit. Now that those customers are asking bank guarantee. So when our customer comes and say, I want to issue a bank guarantee, we might ask the question, why all of a sudden you're issuing a bank guarantee to this company? No, that company is not supplying to anymore. Why? Because I have some dues I have not paid. So therefore they are now telling, if I issue the bank guarantee only, they will supply. That means that is not a good sign. That is not a good sign. So you have to remember, if you have any of these indication, that is called warning signal. So if you get a question in exam, what are the warning signal? Any of these can be written. Late payment, check return, sudden overdraft facility. These all come under that group. I have grouped it to 4. Right? So for better clarity, financial. Now behavioral. What is the second one? Behavioral indicator, where customer is trying to evade now. As a result of his business not doing well, sometimes when you are calling, he is not answering the call. All that is behavioral indicators. That means, is he financially not doing well, all his behavior going to change because he is unable to talk to you. When you are asking some information, he is not giving you the information. He is not contactable. These are behavioral indicators. This is stemming from his financial position. So you have to know, okay, this guy, if you don't smell the financial warning signal, then you will end up with this. Some banks are very smart. Before customer behave, they identify their customer has some issue. They immediately go and meet the customer. That is the best way. Immediately go and talk to customer, or tell the customer come to the bank and ask what is your problem. Why you are not provide the funds. Immediately sort that out. That is the best way to recover the loan. Otherwise, you are into problem. If you allow everything happen, you will end up the loan coming into loss situation, right? That is what NPA, non-performing loan, right? So deception, is trying to lie. When you are asking why you are not calling, why you are not answering the phone, he tried to give some excuse. He's not giving his financial audited accounts are not giving. So because if you are giving it to a company, you need to find when you are giving a loan, you always say there's a condition in your loan application. The customer has to give his financial on every quarter. Audited accounts has to be given. Then only you know if this customer business is doing well. Otherwise, you can't give a loan to anybody, right? You are giving a loan to the company, thinking the company will repay. How do you know the company is doing well? First of all, their accounts. So you need to go for the accounts, audited accounts, right? He's not giving the audited accounts. That means some behavioral issue. That means his financial is not doing well. That is what he's not giving his accounts, right? A reluctant unwillingness to communicate, right? He's not willing to communicate. Failure to respond to specific question. When we are asking, can we have your stock statement? He's sending some old stock statement. You are asking current stock statement. He's giving a stock list of previous year. So unwilling. He's not. He tried to evading request to provide. So he's trying to giving something to in order to get away from you. So you have to identify these are the indicators. You can't afford to miss this. If you afford to miss this, you end up with losses, right? So bank has to react fast. Then these are geographic indicators. As I told you, exchange rate devaluation. So our rupees, you can see that is more important to our country, our region. That is the geographic indicator. Belongs to particular problem into that particular country. We have an exchange rate. In Sri Lanka, we have an exchange rate devaluation. Yes, dollar is going at 230 rupees. Right? That is our issue. Right? Continuous decline in economic growth. Yeah, that is our current issue. Steady growth in money laundering. So that is not happening here. But when you have a money laundering also, the country is not doing well. Then you are into bigger risk because you can see still the drugs are coming into our country. Right? You can see yesterday also amount of drugs have been confiscated because this is where the money laundering. Okay. So when drugs are, people are kidnapped and hijacked, these are something called money laundering activities. So country risk due to unfavorable political environment. Yes, we have been ranked now under C category. So we are at the lowest category at the moment. So these are some of the geographic indicators. We are not doing well at all, right? That is whether we like it or not, we have to accept the fact that we are not doing well at all, right? That is the geographic situation. There could be industry indicators. Sometimes your own industry. So your industry is not doing well because if you take the hotel industry, because of the global pandemic, no hotel industry in the global is doing well. Whether it's Thailand or Singapore, Malaysia, every industry has a problem. So steady decline in the industrial growth. Increase adverse industry regulations such as ban on export or certain. Sometimes when you ban on certain commodity, you can't export. That particular industry might get affected. Or if you put restriction on import, now look at the spare parts now, tires and all, lot of big problem. The tire shops, they are unable to import the tire. The tire industry getting affected because we don't have foreign reserve. We have put a ban on certain import item. Some electrical goods have been banned. You can't import now. Some fertilizers are banned. We are able to import. These industries are going to get affected. The person who's selling fertilizer as a business got affected because of the country regulation, the industry indicators. The industry is now banned. The fertilizer, artificial fertilizer cannot be brought in. Chemical fertilizer has been stopped. So these are something that going to get the industry affected by the government regulation or global pandemic regulation, whatever you may call it. Failure to respond, changing consumer behavior. If your customer behavior changes, you have to adopt. That is what sometimes you can see some of the companies are using their resources into value addition at this moment. So I have seen Kingsbury Hotel and all, they are unable to cater to tourists, foreigners. But the Kingsbury has to be maintained, that hotel has to be maintained, hotel room has to be clean because if you don't keep the hotel rooms and all clean, once the economy is open, you have to spend a lot of money to renovate the entire building. You need to maintain the building on a daily basis. You have to clean the room and you have to open the doors. Everything has to be done. So you need people to work. So hotel has to run. How can they run? So they have to think innovatively. So what they have done, they are taking online orders. They supply food. So Kingsbury now delivering food. If you order, they will deliver your food. So something they keep occupied. So they earn some money. With the same building, they are doing this business. So they didn't have a delivery, but they started delivery because then the chef, everybody get paid at a reasonable salary. They are running their businesses so that those money can be utilized to maintain the building. That is how you look for opportunity, right? That is where if you are a customer, you should have the skill. If you don't have the skill, then your loan become bad because you are not making use of the building to earn something, right? So yeah. Failure, that is what you call failure to respond to changing the consumer behavior. Yeah, you need to change the consumer behavior in such a way to then threat of business shift emerging market. Yes. So when the new shift come, emerging market means with the online order, everybody now buying online. So the person who is physically selling also need to switch on to the online order. He must tell, okay, everybody can order me. Now see Keels, how the Cargills and Keels and everybody switching on to this emerging, everybody taking orders virtually and they are supplied. So Cargills, Keels, every staffs are working. Round the clock they are working. Though the supermarket is closed, they are doing the delivery channel. So there are other people can use those delivery people are also getting business. So this is how the industry should improve, right? Then we are going to classify the NPA loan into 4 categories, right? So this is where the loans are classified according to central bank regulation. Loans are classified into 4 categories. NPA broadly categorized into 4. One is overdue. You can also call it special mention. Remember these 4 categories are overdue, substandard, doubtful, the finally loss. Loss means it's totally out. You don't get your capital. Gone, loss. So you should know, you should not allow any of your loan getting into these 4 categories. The first category is the indication. So if you don't react on those warning signal which we shared just a little while ago, the loan will come into these categories. The loan will first fix into the first category. What is the first category overdue? We are going to look at it. I will give you the notes once you go through, right? Overdue. Now see, what is overdue? These are advances involving normal risk. It is not a very high risk, it's a normal risk of loss due to the unsatisfactory regular debt service. What do you mean by irregular? What do you mean by debt service? Debt means you have taken a loan. Service means you have to repay the loan. That's called debt service. Debt means loan. If a person taken a loan, he has to repay. That is what you call debt service. He has to service the loan, meaning he has to repay the loan. So if he not repay the loan, then there is a problem. There is a risk. Unsatisfactory, irregular debt service. That means regularly is not paying. Irregular means is not paying regularly. Irregular means not regularly, right? Unsatisfactory financial position. His financial positions are not doing well. His profits are now getting reduced. He is incurring losses. So you know the business is into problem now, right? So that is why the loan is going to overdue. Unsatisfactory financial position of the borrower. Insufficiency of the collateral. Collateral means the security you have taken also not good. So that is what we learn. When you are giving a loan, you have to make sure you take a immovable property. That is what the security. So whenever bank gives loan, you have to ensure you take very good collateral security, so that your collateral is sufficient at any time. If you have insufficiency, means you are taken a weaker security. Weaker securities like shares, debentures, these are security you are taken. So this kind of or stocks. The goods what he sells in the stocks as a security, these are not a good security at all, right? You have to take land and building with a good security. If the customer doesn't have, you should have gone for some other security, right? Better security. So your security should be very solid, right? Any other factor which may contribute to raise. Okay. So in this type of overdue facility, we are going to categorize 2 things. One is type of facility, other one is time frame. Time frame for overdue, remember, anything more than 90 days. If the loan is not repaid for 90 days, up to 180 days, that means you are not paid. If it is monthly installment, 90 days means 3 months. 3 months to 6 months, if the loan is arrears, that should be categorized as per the central bank regulation into this category. What is the category? Overdue category. So we are going to look at the type of facility, right? Next slide, you can see the type of facility. Yes, overdraft. If you haven't taken overdraft, right, you have a limit, sanction limit, you have to repay the loan, overdraft limit. If the limit continue to be unpaid for more than 90 days or less than 180 days, then that particular overdraft is an overdue situation. Or if you are giving a credit facility where installment has to be paid monthly, right? Credit facility repayable on monthly. there are 3 installment not paid. 90 days means 3 monthly installment not paid. And 6 installment, 180 days means 6 months. So you can see overdraft up to 180 days, more than 90 days. Credit facility more than 3, up to 6 installment, monthly installment. 2 type of credit. We have other 2 more credit facility. What are those? Credit card and other credit facility. Credit card, the minimum payment is arrears for more than 90 days. But 120, credit card is already given a credit card. Therefore, you don't get 90 to 180. Here, little number of days is reduced. Credit card 90 to 120. All others are 3 to 6 months or 90 to 180 days overdue. But here, credit card, yeah, beginning period 90 days is okay, but not to 180, it's only 120 days. Because credit card itself is given a credit already. Therefore, the credit card be overdue, more than 90 days is become overdue, up to 120 days. Any other credit facilities, if you are taken, the payment is in arrears for 90 days, less than 180 days. So this is what you call overdue credit category. So the period, remember, each type we are going to look at 2 things. One is time period, other one is type of facility. That is what I said, type of facility and the time frame. First category, 90 days up to 180 days. Type of facilities are 4 types: overdraft, credit facility, credit card, other credit facility. So we are going to look at each category 4 types of facility along with the time frame. So we looked at the first category. What are the 4 categories? Here, these are the 4 categories. Overdue. We are now going to look at the substandard one. Let us see how the substandard one. Look at the substandard one. So you can see overdue is a normal risk. But see, now I have put this highlighted a little darker. It is more than the normal risk. Why? The credit, look at the period, more than 180 days, up to 1 year, 360 days. So you can see if any loans is not settled for more than 6 months, up to 1 year, that loan cannot be held in overdue. It has to be shifted to substandard credit. So your loan is your particular loan is getting into the second bad basket. Rightly speaking, you should not allow any of the loan coming into these 4 categories. These 4 baskets are dangerous baskets. First basket is overdue. Second is substandard, because substandard is, is more than the normal risk. Right? Normal risk. The reasons are same. It's financially, all the same reasons are same. But the type of facility, again, we are going to look at it. 4 type of facility. Overdraft, yes, you can see 180 days up to 360 days. Credit facilities, 180 means 6 months installment, 360 means 12 months installment. So credit facility 12 months. Again, other 2, credit card and other facility. Credit card, 120 to 180. Credit card slightly different. So credit card period, remember, if it is 90 to 180, credit card says 90 to 120. Second, substandard category credit card, 120 to 180. Right? Other facility are 180 to 360. So other credit facility, 180 to 360. So we looked at 2 categories. Now we are moving on to the 3rd category. What is the 3rd category? Doubtful credit. So you can see it's a high risk. Doubtful is high risk. So you can see the normal risk, overdue, substandard, above the normal risk. Now doubtful, very unlikely the loan will be paid. Doubtful, it has come to this level. Doubtful means is a high risk of potential default. That means this customer may not pay the capital, not the interest, now the capital. High risk. Look at the same type of 4 facilities, but look at the time frame. 360 days to 540. That means 1 year to 1.5 years. 1.5 years, 540 days. Now look at the 4 type of facility. Again, overdraft. See number of days, 360 days to 540 days. 360 means 12 months to 18 months. You can see here 12 installment to 18 installment. So the substandard category, more than 1 year, less than 1.5 year. More than 12 installment, less than 18 installment. Then the credit card, 180 days to 240 days. The credit card is slightly different, 240 days. Any other credit facility, same, 360 to 540 days. Right. Now we are moving on to the last category. What is that? Loss. You can see in red, it virtually certain that the facility will not be repaid. Here, you need to be aware the loan has come to a level the customer will not pay. That means any facility more than 540 days. 540 days. Facility more than 5. Anything more than 1.5 year, you have to take. So central bank direction says if a loan facility remain in the book for more than 1.5 year, the bank has to take the loan out of the books and absorb it out of their profit. So you can see the 4 vicious baskets, and the 4th one is the loss category where you have to absorb the entire loss. So you can see the 4 facilities are same. Overdraft, exceed the sanction limit more than 540 days is a loss. Credit facility 18 installment 2. Anything more than 18, that means 540 days, anything more than 18 installment. Credit card, anything more than 240 days, yes, that is not 540 days, 240 days for credit card. Any other credit facility, 540 days, 1.5 years, 40 days. So you can see all this will become loss situation, right? So if you have effect of NPL, if you have this situation, so before we move on to NPL, shall we make a small note on this where I said I will give a notes to you? Yeah, classification of loans. You can, under here you can say classification of loans. There you can say according to central bank, according to central bank guideline, issued under, according to central bank guideline, issued under Banking Act direction number, Banking Act direction number 3, number 3 of 2008, according to central bank direction under Banking Act direction number 3 of 2008. On classification of loans, on classification of loans and advances, classification of loans and advances, income recognition and provisioning. So central bank issued a direction under Banking Act direction number 3 of 2008 on classification of loans and advances, income recognition and provisioning. Under this classification, NPA, non-performing loans or non-performing advances, NPA or NPL, non-performing advances. You can write NPA, non-performing advances, or non-performing loan, NPL. Sometimes when you are reading some material, you don't get confused. All are same. Non-performing advances, NPA. Some might say non-performing loan, NPL. Some might say non-performing loans and advances, NPLA, or some might say non-performing advances and loans. Different way they write. So all are same. When it comes to NPA or NPL, remember that is non-performing, right? As for the classification of non-performing, the loans are categorized into 4 categories. Classification of non-performing advances, loans are categorized into 4 groups. First one, overdue. First one, overdue. For easy reference, just put it 90 to 180 days. 90 to 180 days. For all facilities except credit card. 90 to 180 days for all facilities except credit card. Except for credit card. You know what is a credit card, huh? It is not 90 to 180, it is 90 to 120, right? 90 days minimum is okay. So overdue, 90 to 180 for all facility except credit card, right? Substandard, second one. Substandard. 180 to 360. Substandard. 180 days to 360 to all facilities except credit card. Substandard. 180 to 360 for all credit facilities except the credit card. That is 120 to 180. Credit card is 120 to 180. Then the doubtful, third category, doubtful. That is 360 to 540. 360 days to 540. 360 days to 540. For all credit facility except credit card. Losses, all facilities more than 540 days. Losses, all facilities more than 540 days. Losses, all facilities for more than 540 days. All facilities more than 540 days. Right? So this is the notes for you to remember, right? So now we are looking at, okay, so you know these loans should not allow you to get into any of these categories, right? The effect of NPL. What is the effect of NPL? Definitely is going to reduce the interest income, no doubt. Because you don't get the interest because you are putting into NPA. So the customer is unable to pay. So you are going to get your reduce the interest income. Increasing impairment cost. That means impairment means you have to provide the provisions. So remember, what do you mean by provision? Sometimes what happens when a loan is increasing, according to central bank regulation, what you are right in the direction number 3 of 2008, see how the classification goes. It says classification of loans and advances, income recognition and provisioning. Provisioning means you have to do provisions. What do you mean by, in accounting you would have learned provision. What do you mean by provision? If you are expecting some financial expenses in future, know for sure, right? Something going to happen in future. From the current year, you set aside a particular amount. That is you call provisions or impairment. Impairment generally done for assets, but generally for banking we do the provisioning, right? So it is called provisions. There is a provision, means from your current year profit, you are keeping a certain amount out of your thinking this is going to be NPA, a certain amount as a provision. So that what will happen in the event if you are going to not recover the next, because you see the number of days goes more than 540 days, means more than 1.5 years. So first year, if you know there are certain amount of loan, you are going to carry forward to next year because these loans are not paid for last 8 months. So you need to carry forward to the next year. But while you are carrying forward, it's better to do some provide the provision, so that what will happen when you have a bad loans, if you do the maximum provision, it's good for the bank. Why? They have already provided the provision, mean they have already keep a side of amount as a provision, so that next year, if all these loans are unable to recover, you need to write off, you are carrying forward a provision figure, which can be utilized to write off the losses. So it is not the current next year profit going to get entirely affected. If you don't have a provision, say you have a bad loan carrying forward last year, 1 billion, for example, 1 billion, for which you have provided the provision of 200 million already. Out of 1 billion loan, you have provided 200 million provision last year. This year, when you bring that 1 billion problematic loan to this year, you can see by end of this year, you have financial losses of about 4.5 billion. 4.5 million loss, 4.5 million loss out of your entire loan last year You carried forward 1 billion loan this year, problematic loan. Only you provide the provision of 200 million, right? 1 billion loan, problematic loan. It goes to the next year, 1 billion, 1,000 million, 1 billion. Only you provide the 200 million provisions. Next year, when that 1 billion comes as a problematic loan, you manage to recover certain loans. There are certain loans added as a new loans to the provisions, new loans to the non-NPA. You know that particular year, you have to absorb the loss of 500 million. 500 million, you have to absorb the loss. But you know for sure last year you are already provided 200 million. This year you only provide 300 million to write off the losses. If you have not provided last year the 200 million, what would have been the position this year? This year you need to provide the entire profit taking 500 million. So that's going to impact your net profit end of the year because you are going to write off the large amount as a loss this year. So that is what, if you do the provisions every year according to NPA, when the next year is become a bad year, you need not to worry because you kept the amount set aside, right? So something, if I example simple in terms of you, say you are using a mobile, expensive mobile phone, right? You want to use it for 2 to 3 years, but you are using, you have been using for 3 years. Yes, this year is the second year, but you know for sure next year, third year, you can use it or you might go for a new phone. But if you go for a new phone third year, outright you have to purchase for 80,000, which you don't have money. But at the time you bought the phone, you are keeping every year 25,000 for a depreciation, right? You last year you keep out of your savings, you keep 20,000 for a new phone. You bought a phone, but you still keep a 20,000. This year you keep other 20,000. So next year your phone is already busted. You are expecting the phone to go out. Next year, when you want to buy a new phone, you already set aside for 40,000 rupees. You're going for a loan now for a latest phone of 80,000 rupees. You already set aside for 40,000. You only look for a 45,000 to purchase a new phone because the entire phone, the phone what you use is gone. So same thing apply when you are carrying a asset which is going to write off. You better provide some provisions. That is what you call provisioning, right? So that is increase the impairment cost. Additional capital requirement for high-risk weighted. Yeah, you need to increase your capital when your high-risk your NPA loans are increasing. You have to provide more capital because central bank going to say your capital adequacy need to improve. Yes, lower ratings because if your NPAs are increasing, you get your credit rating also will be get impacted because your bank is not managing the assets quality better. Your NPA loans are increasing, so that's going to affect your bank's credential. Bank's ratings also get affected. Reduced risk of appetite for new lending. Reduced risk appetite for new lending. Oh, if your monies are tight with the existing facility, you don't have new money to go for a new loans, new lending. You don't have appetite. So you have a reduced appetite because you don't have money because most of your money is in the NPA now. Additional management time and savings cost to resolve the problem. Yes, you have to keep a separate team to monitor the problematic loan. You have to have a unit, problematic loan administration unit, or some bank might have a recovery department. What is the function of the recovery department? They have to go through each and every loan according to the time frame, according to the type of loan. They have to go and check all these, constantly communicate to the customer. If they have any security, try to enforce the security because the loan is going to become bad. You have to enforce the security. You're not going to write off immediately. Remember, you have to enforce the security. That is how you have taken the security. So when you are looking at the security, there are some issues. That is what the recovery department doing at the time of this situation, right? So how do you manage this? Keep preventive measures, right? So probably go through this. I think I need to stop it because I have exceeded your time. We will do some provisioning, key preventive measures and provisioning. Then we will move on to the IFRS, then the loan. Then with that, we will start the ratio also probably. If we can manage to complete this, we will getting into the ratios also. There is a sum in your exam paper. I don't know whether you would have gone through the exam paper. There is a sum. Don't miss out the sum. You get the full mark. So we'll try to do the ratios also. So that is what I said. We are come to the last last phase of our syllabus, right? So with that, after ratios, there are certain other few areas to cover. So we will have classes to cover the ratios. We will about 2 to 3 sessions. We'll have to go through. We have to do some sums and all. So then I will stop it at this moment and meet you at the next class, right? Stay safe and meet you in the next class.